Well, hey there, everyone. Happy Monday, July 20th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. So thankful to be back here safe in Redmond, Washington. Had a great trip to Boston and New England. Enjoyed reconnecting with some of my musical friends. I have a whole musical part of what I do, and it's so fun to spend time with them. What's funny is they often ask me about investing questions and things that are what I do when I'm not doing music stuff. But it was an awesome weekend. Lots of great thinking about performances and singing and playing and all that kind of good stuff. Hope you guys are all doing well. Congrats to Spain, as a number of you mentioned in the chat. I watched that on the trip home. Pretty awesome ending. Awesome World Cup. That was a ton of fun, top to bottom. Yeah, where are we at? So listen, reviewed the charts on the way home yesterday and did a note or a weekly report for our market misbehavior premium members. Talked about the sort of range-bound environment, things we'd be looking for to signal a rotation, out of this pattern to the upside or the downside. If there's one takeaway I would have from today's session, there's actually a couple of them. Number one, and we'll hit on these themes through the course of the show today. Number one, a relatively strong open led to a pretty weak session at the end of the day. Not a horrible session, right? The NASDAQ was down a tiny amount. The S&P was down slightly. Even the Dow was down about 0.5%. But after a very strong open, I think that's noteworthy. Technology actually finished in the red, even though, some of the chip makers opened in a position of strength. So I would say the fact that there was selling into the strong opened is an important takeaway today. The fact that energy stocks, despite the fact that crude oil didn't move a whole lot, energy stocks are still sort of differentiating themselves at the top of the leaderboard, I think is a noteworthy pattern. Investors, despite crude oil prices remaining sort of flat for the day, certainly seems like they're betting on higher oil prices in the form of energy prices going up. And then rates going higher is another important takeaway as well. Let's get to all those charts and more as we go through the market recap. If you're new to the show, thanks for checking it out. If you're watching live on Facebook, YouTube, X, I appreciate you guys tuning in. You are welcome to ask questions as we go. No such thing as a bad question. Happy to hear from you. And hopefully we'll answer some of the questions here through the course of today's episode. If you're watching later on our YouTube channel, just use the comments section on our YouTube channel. We did an all mailbag episode on Friday, by the way, with some really good questions from all of you guys. And always looking for some more. All right, here was the damage today. And again, I think, as I mentioned in the intro, the strong open was pretty important. And in a note to our premium members this morning, we talked about the stronger open, the fact that semiconductors are doing quite well, and that was an important, potential early development. But that sort of dribbled away through the course of the day. The S&P finishing slightly negative. Down 0.2% to 74.43. So still safely within our sort of range bound, what we call a basing pattern, still safely above support, also below resistance, kind of right down the middle there. The NASDAQ literally was up for most of the day until the last kind of, really it was the afternoon that kind of killed it. But going into the close, dipped slightly into the red to finish things off. Volatility, though, remaining fairly low. The VIX did get down to around 17.5. It did push higher going into the close, still below 19. So as long as the VIX is below 20, we say that is a low volatility environment. And generally speaking, conditions looking okay in terms of volatility. Anything above 20 would be a danger sign. Not there yet, but boy, a day like today just felt like we were going to get there at some point. Rates generally moving higher today. And so the 10-year yield is right around 4.6%. So not quite breaking out of the little range it's been in, but pushing up a little bit here. Long bond yields up above 5.1%. So the whole sort of yield curve, sort of mid to longer end, all kind of drifting up a little bit here. And that's certainly something to pay attention to, because through the month of July, we saw rates kind of pull back a bit and then just starting to rotate higher again going into this week. Dollar slightly higher. That's certainly a chart to pay attention to, along with crude oil, gold, some of those major asset class indicators. Looking at the commodity space, gold had a very choppy session. Silver was a little bit better. I would say the chart of gold still very much a challenging setup. Gold's been generally finding support around 4,000 an ounce. But our chart of the GLD, clear downtrend. Our market trend model says it's in a clear downtrend. So we were avoiding until further notice, although full disclosure, I do have a position in the GLD, as I pretty much always will, because I like to have at least a little bit of gold, even when I don't think it's a great chart for whatever reason. Crude oil prices, generally choppy and sloppy, but not a lot of upside here. Again, given the escalation or the re-escalation, I should say, in the Middle East here over the last week, I'm surprised that crude oil hasn't gotten much above $80 a barrel. That's we're about $83 a barrel on the WTI, which is the main U.S. benchmark. $89 a barrel for Brent crude, which is a European or sort of a global benchmark for crude oil. So generally kind of pushing higher here, not as high as you would have expected, right? So earlier in the conflict, like February, March, crude oil got up to like 110, almost $115 a barrel. So we're still obviously safely below that, but pushing above 80, I think, is where people have to start to sort of wrestle with that. Soybeans continuing to work after a pretty decent week last week as well. Cryptocurrencies generally positive today. You can see Bitcoin's above 65,000 here as we're going live. Early evening on Monday, July 20th. Ethereum price is up with Ether above 1,900. So overall, generally speaking, crypto's doing okay today. The sector breadth sort of got more and more negative as the day progressed. So earlier in the day, you had more sectors that were up. Here at the close, energy, really the only sector having any meaningful upside, up about 0.5%. You can see communication services and technology just slightly above zero. And then on the downside, you've got 8 of the 11 S&P sectors in the red. Healthcare, the worst performer, down 1.1%. Materials down about 1% as well. Breadth was not great today. So while the benchmarks were basically flat to slightly lower, the breadth got worse as the day went on, right? So it was and again, this is why today I would say was not a particular strong start to the week here, because we had a nice open where it felt like some optimism here coming out of the weekend, but sellers kind of dominating through the course of the day. At the end of the day, it's about a 2-to-1 ratio for most of these breadth indicators. At the top there, that's the New York Composite Index, 62% decliners versus 36% advancers. And the mid-cap index is about a 3-to-1 ratio, 75% decliners there. So this was a broad decline, not a huge decline, right? Not a huge sell-off, but a broad decline, meaning many things were sort of lower today. Looking at the 9 Morningstar style boxes, large cap growth, the only one of these 9 buckets that actually was in the green today. Everything else was down. Mid-cap value generally was the worst place to be today. Looking at Dave's Dirty Dozen, these leading growth stocks and ETFs, some Microsoft continuing, I would argue, to look more and more like a pretty clear double bottom pattern, pushing above $400 a share to 402 and change. That's up about 2.2%. Broadcom, Micron, both up about 2% today. I mean, the chart of Broadcom still in what we call moving average limbo between the 50 and 200-day moving averages. My weekly show on Stock Charts TV, probably not posted yet, but it's with the editors now, hopefully out there later tonight. But we talked about this moving average limbo. And when charts are in a strong uptrend, they pull back below the 50-day, but still hold the 200-day. There's a number of growth stocks that have that particular setup. And I talked about just some best practices on how to think about that pattern, some historical examples of when they resolved higher or lower and what to look for. So check that out on the Stock Charts TV YouTube channel. It's a weekly show I usually do on Mondays, and I just got that out earlier today. I'm not sure if it's posted quite yet, but hopefully very soon. So plenty of things kind of doing well here. But what was down? SpaceX, in the month of July, and I'll show you the chart in a minute. How many how many up days? Yeah, how many up closes? How many closes above the open has SpaceX had in the month of July? How many out of the 15 trading days so far in July? 2. I think the number's 2. I think only 2 out of the first half of the month has SpaceX actually closed above the open. That tells you, I think, at least tells me all I need to know about the sentiment surrounding that particular stock at this particular moment. We're down below 120 now for the first time, down about 3.33%. Tesla is an earnings name this week. They're reporting later this week, down about 3% today, and Apple, which I would say without argument has been the strongest of this basket of stocks in recent weeks, down about 2.1%. after making a new swing high last week. I think that's it to set the table here. That's what happened in some of the major indexes and some key stocks. Let's look at the heat map next. We will talk about what this configuration means. This gives us the opportunity to look at the overall landscape, but then focus in on some stock and sector themes. As a reminder, we're going live on Facebook, Facebook, YouTube, and X. And I appreciate you guys so much checking it out live. Those that are doing so, you are welcome to ask questions as we go. I see a question or two I'm going to grab here a little later. If you're watching the show later on our YouTube channel, just use the comments section. We have a mailbag episode at the end of the week. We are planning one for this coming Friday, and we'd love to answer one of your questions this week. All right. So what happened on the heat map? Obviously kind of a mixed day, right? I mean, if you look, there's some green, there's some red, but I would say the average color on here is neutral, right? I mean, this really was sort of a digestion day, right? Sometimes the market has a directional tilt where it feels like more of a broad accumulation or distribution. Then there's sort of a digestion day where it's sort of like we just sort of churning around and kind of digesting the meal we ate. And that's how it felt like today here. Not a particularly strong day in the technology sector, and that's why the benchmarks are relatively flat, to be honest with you. A lot of days recently, technology has been like the top sector with these big moves to the upside, or the worst sector with some big individual down days. Even the names in the technology sector that moved did not move very much, right? We've been getting used to like 8 to 10% swings on an average trading day here over the last 6 weeks. This was relatively quiet, right? So you see semiconductors generally slightly higher. You can see software generally slightly lower, but that was about it. This is one of those sort of lowest volatility days for the tech sector that I've observed in quite some time. In terms of what's noteworthy here, I would say the down day in Apple, again, the chart is still great. Again, if you line up all the sort of Dave's Dirty Dozen charts, that still is clearly at the top of the list for me. But a down day to start the week, which is something to watch. I think they're for earnings. I think they're set for earnings next week. For the next couple of weeks, we're going to get a lot more of the sort of Mag 7 group reporting earnings. So that was up with technology. Otherwise, really, I mean, very much a mixed day today. I don't know if I see a particular theme on the heat map. One thing would certainly be the energy sector was the only one that really had any sort of meaningful update. Not all of these charts are great charts just yet. You have sort of the early leadership names, the names that did well, even when crude oil prices were relatively weak. So these are some of the sort of downstream oil companies like Valero and MPC. PSX is another one, right? These are sort of like the gas station names, but then, you know, some of the big integrated names like Exxon and Chevron kind of bouncing higher. What I would tell you is on the charts of Exxon and Chevron, draw a trend line off of the major highs over the last 3 months. And most of those are kind of breaking above that trend line. So I think that's kind of interesting. Other than that, honestly, quiet day here. There's a lot of earnings happening through the course of this week. There wasn't a lot on the earnings calendar today, but starting tomorrow, Wednesday, Thursday, even Friday morning, there's a bunch of companies reporting. So a lot, I would say, we need to keep an eye on. Honestly, I don't want to belabor the heat map. That's kind of where I'm at with it. For me, I would say a lot of charts that I'm looking at have kind of clear levels that I'm watching, and very few of those levels were triggered today. I've been setting a lot of alerts recently on charts like NVIDIA with clear resistance and clear support. And a lot of these names kind of remain in the middle of that range. All right, we're going to continue on here looking at some charts. I'd like to get to the charts as quickly as possible. Before we do so, do want to give a shout out to one of our partners, Koifin. Specifically to my advisor friends, this is a platform that it is sort of like a very, cost-effective version of the Bloomberg terminal. This is a platform that I used for many, many years. I worked there and then used it as an institutional investor. But it is an obscenely expensive platform. Bloomberg is. Koifin is just a much more reasonably priced alternative with deep fundamental data, great coverage of international markets. If you're an advisor, particularly, they have really good report writing capabilities. It's designed as a set of tools and visualizations to enhance your discussion with a client and to show them what's happening to their portfolios, show them different scenarios, your own model portfolios, report-ready presentations, all of that all built in. If you go to marketmisbehavior.com/Koifin, you can get 20% off a new account. I would encourage you to check them out. If you're an individual investor, by the way, I use it every day for ETF holdings, attribution analysis. It's a fantastic tool. So again, marketmisbehavior.com/Koifin, Koyfin. If you use my link, you can get 20% off a new account. I would encourage you to check it out. And I want to thank my friends at Koifin, as always, for supporting Market Misbehavior. We are doing a webcast this week on Wednesday, the 22nd, 1 p.m. Eastern, 10 a.m. Pacific. I'm doing a presentation called Morning Coffee Routine, Dave's Daily Framework for Market Awareness. I honestly look at the same set of charts every morning. I call it my morning coffee routine. For me, routines are essential. I have a weekly routine, a monthly routine, and a daily routine. Today, we're going to focus on that daily routine. You get your cup of coffee, you sit down, fire up the laptop. What do you look at first and why? We're going to talk through some strategies. I will show you sort of behind the scenes look about how I prepare for the trading day. And I hope that at the very least, it encourages you to reflect on your own process. Maybe think about some incremental improvements you can do. I started Market Misbehavior years ago to help people improve their processes and routines. And this should hopefully give you a little slice of that. You can sign up for that free event coming up this Wednesday at marketmisbehavior.com/coffee. I will hope to see you guys there. All right, let's finish off looking at some charts that I've hand selected that I think tell the story of this market environment. The S&P, to start off, is in a sideways trend. One of my good friends, Dave Landry, literally, I'm not kidding, has a tattoo on his forearm and has an up arrow, a down arrow, and a sideways arrow. And I am not into artwork on my skin, but I am a huge fan of that way of thinking about trends, right? The market can move in any of three directions: an uptrend, a downtrend, a sideways trend. And I would argue the first part of your analysis of any chart should be answering that question. What is the trend? Up, down, sideways? Because all the other questions have to start at that beginning point. The S&P is sideways, right? This is not a particularly bullish chart at the moment. It's not a bearish chart. It's literally a neutral chart. And by understanding that, that gives us a framework with which we can define that range, or that what we call a basing pattern of consistent highs and consistent lows. But we can also identify what would tell us that pattern is changing. So I think the S&P above 7,600 is a pretty bullish chart. I would say the S&P below 7,300, pretty bearish chart. I would say the S&P in the middle is neutral, and that is exactly where we're at. The RSI is at 47. It's almost dead even at 50. And so, neutral momentum, neutral trend. So the market is telling you we are waiting, right? We are in wait and see mode. We've priced in, what I would say is we've kind of priced in where things are at. Now we're waiting for that next catalyst. And we've got plenty of things that could shift this market around. We've got another Fed meeting coming up next week. We've got plenty of earnings this week and next week and the week after. Really, a fire hose of earnings for the S&P 500. We've got conflict in the Middle East, crude oil prices, inflation, et cetera, et cetera. But until and unless we see a break out of this range, I think the chart of the S&P is neutral. I 100% love that. My favorite Jesse Livermore quote: "There's time to go long, time to go short, time to go fishing." Well said, and I would agree. For me, this is a time to go fishing. And again, I feel like we get into trouble as investors, as traders, when there's not a great opportunity on the chart, but we trade anyways, right? We try to create an opportunity that's not there. The opportunity is not there. We need to wait for the setup. I don't think there's a great opportunity right now. And I'm watching that range to look for any shift. But I'm seeing neutral momentum, neutral trend. I think it's neutral until proven otherwise. Now, an alternate way, I guess, an alternate pattern to think about here, and I was asked about this last week, is labeling this as an ascending triangle. I get the argument, right? An ascending triangle would basically be me saying 7,600, 7,550, that sort of level looks like the clear resistance. I think that's fair. But then we have an increasing level of lows, right? So it's more of an ascending triangle with a flat top and increasing lows. I don't have a problem if you label that way. I would say the bullish outcome is identical, right? In either situation, whether you see this as just a consolidation pattern, which I would favor, or an ascending triangle, which I get the argument. In either case, a break above 7,600 would be pretty bullish. And I would say until you see that, it's just not that bullish of a chart. Over the long term, obviously still just fine. Our market trend model is still bullish on the medium term and long term time frames. That tells me the long term trend is up, but it's that tactical time frame that I would say is not particularly strong right about now. So 7,600, I think, remains a key thing to look for. As we discussed with our premium members over the weekend in our weekly flight plan, our market trend model did turn bearish. This has happened a couple times here off of the March low. So here's that March, the sell-off into the March low. Soon after, our short-term model turned back bullish. Then we've had 1, 2, 3 times now. And the previous couple times, it's just been for 1 week only when the short-term models flipped negative. And so what that tells me is, with the long-term and medium-term clearly bullish, with the short-term negative, I describe that as a tactical pullback within a long-term uptrend. Medium-term model turns bearish. That would tell me this is something to be more concerned about. End of February, we got one of those signals. End of February of last year, we got one of those signals. Those last 2 times we've had that sort of medium-term bearish signal. We're not there yet, right? We still got some room before that would happen. So at this point, I'm seeing this as a tactical kind of corrective move within a long-term uptrend for now. The breadth was not great today, not enough to really shift breadth indicators that I follow, sort of medium-term or long-term breadth indicators anywhere negative. The McClellan oscillator's back below zero going into this week and would certainly remain below zero after today's session. However, we're still 62% of stocks above their 50-day, still 67% or 66%, I should say, above their 200-day moving average. Those are still pretty bullish ratings. This gets below 50% here on the bottom. That would tell you we're starting to see some breakdowns in the S&P members. I'm not seeing a ton of that yet. So I would say breadth indicators still fairly supportive here. More days like today, though, those indicators can turn south very, very quickly. The VIX is bouncing higher. On Friday, we pushed up to just above 19, but finished just below there. Today, we kind of teased 19 as well. We're at an 18 handle going into the close today. We're getting pretty close to 20, and a break above 20 for me would be a big red flag. Last time we had a big spike above 20 was in early June, which told us to be ready for that sort of pullback scenario. We're still below 20, which tells me that the volatility is relatively low. Big spike in volatility just means the options market is pricing in larger swings. That's usually way more reflected, way more often reflected in a bearish tape. Rates popping higher today. So Friday, you saw bonds rally, and we saw rates come off a little bit. The 10-year yield finished the week below 4.55. Today, we actually pushed slightly above 4.6%. We kind of closed right at that level. We're pretty close to making a new high for the year here on the 10-year yield. The last time we got up to this level was in mid-May, and that ended up being the peak in the 10-year Treasury yield so far year to date. Rates go higher from here. There's a number of ripple effects that can cause, but the one that I think is most concerning would be when rates start to go up, growth companies seem to be less valuable, right? When you're creating a valuation model on what we should be paying now for the future earnings of these big growth stocks, planning, future earnings growth, the current interest rate is part of that calculation. And if rates are higher now, it basically implies that the future earnings of those big growth companies are just less valuable today. It's all about the present value of those future earnings. And so the present value calculation goes the wrong way if rates start to go up from here. So I would say there's risks for different areas of the market, like home builders, the consumer names. Higher rates usually are bad for those. But I would say the most concerning now would be when valuation models start to make growth stocks look less attractive today, because that has really been the engine of this bull market, has been euphoric valuations of growth companies. So if valuations are lower today, that's not going to be good. And what would happen, I would say, would be analysts would start to lower estimates or, lower their, targets and basically, suggest that we shouldn't be trading at these multiples today, given the interest rate environment. Crude oil pushing higher, pushing above $80 a barrel on Friday, continuing above there today. Obviously, the headlines over the last week or two have gotten less and less peaceful and more implying that there's a real re-escalation. Honestly, I'm surprised, given the headlines and I think their implications, surprised we're not seeing more of a move in crude oil. You're certainly seeing a pretty decent move in energy stocks. They've continued to go to go higher there. So crude oil, I would say at this point, pretty good uptrend from a technical perspective. Holding $80 a barrel, I think, is pretty meaningful. We're at that moving average limbo right now between the 50 and the 200 day. Above the 50 day, which would be above 85, will be a pretty bad sign as well. Bitcoin starting the week off pretty well here. Over the weekend, kind of chopped around the 64, 65,000 range. Today, kind of pushing back to the upside. We have a target around 67K. Anything above that would be pretty good. I do have a position in GBTC right now, playing off of this, bullish momentum divergence and seeing if that works. Still holding that position, but overall, I mean, Bitcoin, I think an undeniably interesting chart if we get above 67K. I think that's a good alert to watch. All right, looking at some individual names. I mentioned my show on Stock Charts TV. I hope you can go check that out because we talk about this whole kind of moving average limbo thing, right? You've been in an uptrend. We're below the 50-day, but still above the 200-day. I would say for the chart of Alphabet, for me, this is a not interested kind of chart until we break above 370. That would mean a break back above the 50-day moving average. That would mean a break above this neckline or this resistance level, this trend line, whatever you want to call it. But I think getting above 370, pretty important. Last Wednesday and Thursday, we had this really classic bearish engulfing pattern. And sure enough, Friday was a gap lower. Today kind of popped up and ended up being what we call a gravestone doji, where the open and close are near the lows of the day, big and almost identical, and then a big upper shadow. So suggests weakness here to start the week. I mentioned just a quick, poll question. How many up days has SpaceX had in July? And by up days, I mean just closing above the open too. This is where candle charts, I think, tell a very clear illustration of what's going on the stock. I mean, this is a stock in a clear distribution phase, right? There aren't a lot of willing buyers coming in and loading up on SpaceX, or else the price would be heading north. It's heading south, and every day we're just seeing a little bit more distribution. We're now below the IPO price. That was 135 back here from early June. So, for me, we have an RSI down around 40. We're not having a lot of up days. Like, I am happy super sitting this one out and waiting for some signs of accumulation, some indication of an upward rotation. Something like a daily MACD can be a really good way to validate any sort of upward turn, but none of those indicators are showing anything but negative at this particular moment on SpaceX. Now, AMD, in terms of charts to watch, I think this is a vital one. This isn't set to report earnings for a couple of weeks, but I would say the bearish momentum divergences that we're seeing on AMD and other semiconductors could end up being, arguably the story for the third quarter. The fact that these leading growth names did so well in Q2, but all finished June on much weaker momentum. And this is just a classic divergence that we would teach in a textbook on technical analysis. And it's a perfect example. So we've started to pull back a little bit, of course. And so the question is, do we see further deterioration? Breaking below that June low, RSI breaking below 40, those would be the things that would validate a new distribution phase for AMD. And again, that would weigh pretty heavily on things like the NASDAQ, certainly the S&P, if you had names like that, breaking down any further. A lot of earnings coming up this week. A bunch of names in the S&P 500 are reporting. We'll do our best to highlight some of the interesting technical setups around earnings. I did want to highlight Interactive Brokers, kind of similar to the chart of AMD. This has just been a great chart. Been in an uptrend, higher highs and higher lows, moving averages sloping upwards. Momentum has been strong, but not excessive. That's pretty good. We're bouncing off of the 50-day as of Friday. Again, this is the kind of chart that I would say at this point looks like a really good chart. So we look for something to change. We look for a break of the 50-day. We look for more negative momentum, look for deterioration and relative strength. For now, pretty good chart. So going into earnings, I would say a pretty decent overall setup. And if there's anything to, be concerned about, it's just that we've stalled out and we hit 97.50 about a month ago, and we've just kind of bounced up against that ceiling, and that's it. So for me, I set an alert at 97.50 for a break above there. I'm actually writing that down because I don't know if I actually set that alert. I meant to set it earlier, but I don't know if I did. So I'll set it after we're done here. Domino's Pizza reports before the open. Not a huge name, but one that tends to be followed pretty well. Today's action looked a lot like the S&P. Friday was the same. Decent open, but we closed lower. So you're getting some sellers coming in during the trading day. It's even though it's kind of breaking out and making a new monthly high, it doesn't feel like a lot of accumulation because we're kind of finishing more toward the lows of the day. Domino's has been below its 200-day moving average since summer of last year, almost a year ago. So generally, this is not the type of chart that I get too excited about. But I like the bounce off of the June low. The momentum is getting pretty close to where it starts to look constructive. Love to see if we can get a better indication than the days we've seen on Friday and Monday here. They actually are reporting, I think it's before the open tomorrow. Even this says today, but I might be wrong on that. All right, KDP is one I wanted to highlight. Potential head and shoulders top, but it's just a potential head and shoulders top. I had some questions on this last week. I just want to remind you that when you have a head and shoulders top that looks like this with a head and a left shoulder and a right shoulder, excuse me, you do have to wait for a break of the neckline to confirm any sort of deterioration, right? So it's not a confirmed head and shoulders top until and unless we break below that neckline. So I would say very close to this chart looking pretty negative, but holding for now. That's ticker KDP. Final chart to highlight for you, Take-Two Interactive, TTWO. This is one facing a confluence of support. You've got the 50-day and the 200-day right around 230 to 233. You've got a Fibonacci support level right around 236. We're kind of right at that combination, what we call a confluence of support. As long as those things hold, it's still a pretty good chart. But if and when those levels break, all of that support fails, that's where you want to get out of the way. So the way that I would think of it is, and I don't have a position in Take-Two, but like you take a position on, a day like today, betting on a bounce higher. We use these levels like the 200-day as an initial stop, just right, thinking of that confluence of support as the floor. And if it holds, you've got a pretty good setup. Risk reward is pretty good. If it fails, you minimize your losses. That's how we can use some of these levels and wiggles and squiggles on the chart to set up some a structure, I guess, for the trade. All right. Shall we look at some questions here? Boy, there's a bunch of these. So let me see what I can do here. Yeah, someone mentioned the low VIX, nobody's fearful. 100% right. So, I mean, while I think there's some issues with this market, the low volatility, narrow credit spreads, I mean, those are two things that are giving no sort of warning signs right about now. So I would say that's pretty important. Let's see. Yeah, someone had mentioned Colin as an idea for it. Colin, boy, I actually don't remember how to pronounce Cisnewski. Maybe I forget how to pronounce his last name, but I do know Colin. He's based out of Toronto. He is a CMT and a CFA charter holder and a money manager. I do know Colin, and I should get him on the show. Thanks for that suggestion. Man, I saw a question earlier and I totally missed it. This happens way too often. There's a way on this live stream platform that I can actually save a question for later, and then I always forget to do it. So that really kind of avoids the kind of doesn't help me. Oh, no, great question, Richard. Thank you. Dave, our president states that the U.S. and Venezuela are producing more crude oil than Iran ever did. So why is WTI price so sensitive to the war going on with Iran? So listen, I mean, to be honest with you, it's a fair question. The traditional mentality about what, there's a playbook, like what happens when there's a conflict in the Middle East. And traditionally, it causes spikes in crude oil. And the reason is, for the longest time, that was sort of the epicenter of crude oil, and certainly is still obviously a huge producing region. And the U.S. in conflicts past was very heavily reliant on that crude oil. Now the U.S. is energy independent, which is very different. Now the U.S. is producing a ton of crude oil, which is different. And so the things have shifted a bit. Now, having said that, like Europe is still very dependent on crude oil from the Middle East. China and in Asia, Japan, still very dependent on oil from the Middle East. So just because the U.S. is energy independent doesn't mean that other global regions are. And as much as we want to think that the U.S. is our own independent thing, like the global economy is very much a global economy in so many ways. So if one part of the world kind of sneezes because of all this, we're all going to catch cold in some way. So I would say there is going to be a negative impact if that supply of crude oil, even though it's not 100% of the global supply of crude oil, it's a decent amount. So yes, the U.S. produces a ton of crude oil. We, are generally, energy independent. Does that still mean crude oil prices are probably going to go up? I mean, it would. Now, having said that, remember, it's not just, and this is why, like on a day like today, it's like I'm surprised crude oil isn't higher. But you have to remember, there's a lot of different things at play here, right? There are strategic petroleum reserves that different countries have been drawing down on. That has probably helped to keep the, price of crude oil lower. At some point, does everyone have to refill their strategic petroleum reserve? Does that end up making the prices higher later? Like maybe I've heard some decent argument that's it. What you have to remember is that while we can always, sort of project or guesstimate what the impact is going to be on the prices of crude oil, there's just a lot of moving parts to this. And as much as we want to think of it as a simple relationship, there's this conflict, there's this headline about Iran and US and Israel, crude oil prices are going to go up, energy prices are going to go up. Like, it's just not a simple relationship like that. There are just a bunch of other things going on. But having said that, so that is why I would say that the kind of traditional playbook is different now. And so that's why we can't just say what happens when there's a war in the Middle East, because it's a different environment right now. But I would still say things that I've read that talk about how the U.S. is producing so much crude oil, it doesn't matter. I just don't buy into that. Is it less of an impact to the U.S. particularly? For sure, because we've got plenty of oil here now. But is it still impacting the global economy? For sure. And just remember, other areas of the global economy with which the U.S. is still intimately connected will have issues with it, and that's why I think it's still very much something to pay attention to. That is the crib notes version of that. Friendly reminder to myself, I should get another good energy expert. I had some really good energy discussions on the Market Misbehavior podcast, so I'd encourage you to check that out. Yeah, and then I just want to. There's one other comment, and yeah, thanks for mentioning this. Buy when others are fearful and sell when they're greedy. There's a whole sort of side conversation going on there. I just wanted to highlight on it. It's a great point, and there's a classic quote about that, right? About buying when others are fearful, selling when they're greedy. And so what you're implying is kind of the traditional contrarian point of view. I want to buy weakness and sell strength. And I think on the chart of the S&P, if you look at like the daily chart of the S&P, that's kind of what you see when you have a range-bound environment, right? You want to be selling when others are greedy and buying when they're fearful, right? Buying the lower end, selling the upper end. I would say on certain time frames that works remarkably well. And what you're describing, I would argue, is sort of the swing trading time frame where being a contrarian can really pay. What you have to remember is if you look at momentum investing, if you look at momentum models, which are usually looking at months at a time and not days at a time, but you're looking out a couple months, 6 to 12 months, momentum tends to work, meaning you're better off buying when others are greedy and selling when others are fearful. And that's one of the ways that I think a lot of investors and a lot of traders don't recognize that different timeframes actually work very differently. Swing traders have realized that you can bet on the opposite, right? So if everyone's on one side, you sell into that strength. And that's why looking at like a 5-day RSI can give you some great swing trading setups because of that reality. But over a longer period of time, trend following works really well. And trend following is actually doing the opposite. That's buying strength and selling weakness. That's why we're talking about that, within this range, it's more of a trading environment. But if we start breaking above 7,600, I don't think selling when investors are greedy is a great play anymore. I think that's when you want to be sort of buying into that breakout. And I think recognizing which time frame those approaches work better than others is arguably an important premise of technical analysis, and a great advantage that we have as technical analysts is being able to operate on those different timeframes. I'll try to do my best here in the days and weeks to come to dig into that a little bit more, because that's something that I know some traders kind of struggle a little bit with, is recognizing those different timeframes. In the meantime, hey, thanks for joining me today. Hope this helps give you some ideas, helps you make sense of what's happening in the market, keeping you updated and informed, but also thinking about how you can make better decisions in your own portfolio. Please keep the questions coming. We'll do an all mailbag episode on Friday. Please go to marketmisbehavior.com/coffee and check out our free event coming up this Wednesday. In the meantime, have an awesome evening. And remember, it's always a good time to own good charts. Take care, folks.